Hello and welcome to the 6th edition of our Investment Insight series, Magellan Minutes. My name is Jennifer Herbert, Head of Listed Funds at Magellan, and today I'm joined by Alan Pullen, one of our portfolio managers. We'll be discussing the recent bank defaults, the impact of interest rates on banks in general, and where we see opportunities in the financial sector. Thanks for joining us today, Al.
Oh, pleasure.
Al, you recently spoke on one of our Insights videos about the collapse of Silicon Valley Bank and Credit Suisse. Have there been any further defaults since then, and what's the risk of contagion?
Well, thanks, Jen. Yes. So thankfully, no further defaults in the past month or so. So we obviously had a lot of excitement in March, and there was a real risk of contagion throughout the system. As we spoke about at the time, the defaults themselves were largely idiosyncratic issues for those banks. Poor balance sheet management, narrow business practices, and low quality deposit bases. So we did not think that the large banks were going to be impacted by that because we thought they were much better positioned to 2008. They were well capitalized, heaps of liquidity. They're highly profitable. But the contagion risk was that people would see these banks failing, think back to the GFC, and then you get bank runs. And even a well-capitalized bank can't survive if all their depositors tried to take their money out at once. So that was the fear. As we said at the time, we thought these banks were structurally actually okay, and the regulators stepped in very quickly to help resolve those failing banks. So Credit Suisse was sold to stronger rival UBS, for example, preventing that contagion. So it was a concerning time, but as we've seen over the last month, those steps taken by regulators appear to have done the job. Investors, depositors have become more confident, and we think they should be, because we think those banks are actually in okay shape. So it appears to have played out sort of as we expected, in that the contagion hasn't become more widespread, certainly within the banking sector. So that's the good news for now. Certainly, I wouldn't say we're completely out of the woods yet. We're still got higher interest rates. The Fed still raised rates, another 25 basis points, notwithstanding this concern. So there are still stresses out there in the system. We continue to think a systemic crisis in banking system is unlikely, but could we still see things pop up in other parts of the market? We're in that kind of environment where that risk is it could happen. It could be a small idiosyncratic bank. It could be something in private equity, which seems to be quite leveraged, venture capital. So not completely out of the woods yet, but that real risk of financial crisis, a la 2008, appears to be behind us.
And as interest rates rise, the first order impact on banks is generally pretty positive. However, the second order impacts can be very negative over the longer term. Can you explain that?
Yeah, absolutely. So one reason to own banks in a rising rate environment is it actually helps your net interest margins. And I've spoken about this before, but just quickly, deposits do go up in price, but they don't go up in price for the banks as much as their assets go up, because they have that suite of low-cost transaction accounts, which don't tend to go up much. If you go to the bank, you're not really getting much more on your transaction account, notwithstanding the increase in interest rates. However, the banks do earn more on their asset side, their loans and securities. So generally, it's good for their net interest income. And we've seen the big banks in the US, they've just started their reporting season, and their net interest income is up 40% plus year on year. So they are reporting really high levels of profitability, and that's good. So that's the first order impact for banks. And it is a reason that you might want to own banks in a rising interest rate environment. And in fact, we did own a couple last year, exactly for this kind of reason. But the second order impact is negative, and that's what we have to worry about. That's why we're pulled back on our banking exposure. We only have one small position in a bank, a high quality US Bank Corp. And that's because of that second order impact. Higher rates come with a slowing economy. That's exactly what the Fed is trying to achieve, right? And that slowing economy could tip into a recession. At the moment, we're thinking probably a softer slowdown, but there is a chance it tips into a harder slowdown. And that risk is exacerbated by the recent banking issues. So there is a real risk that we get a recession, and then notwithstanding the improvements in net interest income, you get credit risks. And credit risks are really the big risks for banks. They are leverage plays, and you end up with significant losses on the credit book. It doesn't matter that you earn more on your net interest income.
Well, it's comforting to know that our exposure to banks is low and limited to US Bancorp, as you said, and that is one of the highest quality banks in the industry. Where else in the financial sector are you seeing opportunities?
Yeah, no, that's a great question, because we've talked a lot about banks recently, but we don't actually invest in many banks because they are quite cyclical. There are risks out there, and they're just not the highest quality companies in our investment universe, saying the least. So there are certainly more interesting places within the financial space for long-term investors, quality investors such as Magellan. And I would like to talk about Brookfield, which is a recent addition to the portfolio. This is a really interesting company. It's an alternative asset manager based out of Canada. It has $1 trillion of FUM, so it has enormous size and scale, and it's really an attractive part of the market. So what do I mean by alternative assets? That's kind of real assets, infrastructure, real estate, renewables. So a huge player in renewables. In fact, so they're one of the largest players in renewables in the world. We think this is really interesting because they are a attractively positioned asset manager in that pension funds are continuing to allocate a greater proportion of their assets into these renewable assets. So you've seen a really good growth in FUM over the last decade from these guys. They've also got a bit of a unique model in that they co-invest along with their investors. So they have a huge balance sheet and they invest along with kind of their outside investors into renewable projects, into infrastructure projects, into property. So that provides really good alignment with investors and a lot of comfort when they're going out to raise FUM for these alternative assets. We also like the long-term nature of that business. So the CEO there, Bruce Flatt, he's been CEO since 2002. He really brings a value orientation. He brings a long-term perspective. And he's all about building a company with sustainable competitive advantages, which is exactly how we think about investing here. So a real alignment of management cultures, we think. And as an aside, they also own a majority stake in Oaktree Capital. Oaktree Capital is managed by Howard Marks, who is a bit of a legend in the investing world. And personally, I've always looked at his memos as great places to get investing kind of advice. So I would, if there's any aspiring investors out there, I would go look at his memos. So, it is an interesting collection of assets that they have. It is somewhat complicated because they have an asset manager, but they also have stakes in listed investment vehicles, and they also have direct investments, all these direct investments they're making with their investors. So it is a bit more complex to work through. But the analyst, James McDonald, he's done a great job in diving into the financials. You need to do the work on this one to make sure you have a clear view on valuation and the risks that sit within those structures. And we think we've done that. And we have a really clear view on the valuation of that corporation. And it's interesting because it's at a really big discount at the moment to its underlying valuation. We think that's because there are some property assets in there. Property assets are under a little bit of pressure at the moment, and we could see some pressure on valuations, particularly for office properties, for example. But James has put a 50% discount on the value of those property assets. Even taking that into account, we think the overall corporation is valued at about a 30% discount to the sum of its parts, its direct investments, its stakes in listed vehicles, and its stake in the asset manager, which is also separately listed. So a bit more complex, but worth doing the work on because it's a really attractive company in a growth part of the market with a long-term orientation and trading at a really attractive valuation to the underlying sum of its parts.
Fantastic. Al, thank you.
You're welcome.
And thank you for watching. If you have any questions, please don't hesitate to reach out to the Magellan distribution team and feel free to share this update with clients and colleagues as you see fit. Take care.